Hi, it's Payam here from Niche Advice. Right, so I recently did a video which did really well on TikTok. I think it's had over 15,000 views on TikTok and many comments and shares, right? And it was my view around some of the social media stuff that I've seen in regards to paying off your mortgages and buying properties. And I think I'm one of the few out there that has got a different point of view on this one, okay? Now, I've seen many people, many of them much more wealthier than me, I have to say, and probably much more successful than me, okay? So there you go. There's my disclaimer to say, look, what their theory is, look, don't pay off your mortgage, keep that money and invest it in ultimately other properties. Those properties will then generate cash and income, enabling you to live the life that you want to live, buy a Ferrari, buy a Porsche, pay down your mortgage if you want, and have assets that are generating income. So good debt, they call it, generating income, but also that will rise in value. Okay, so that's the theory, and that's what there are lots of videos out there about that. Now, this is why I disagree, and this is how I disagree, and I could be wrong, I could be right. Let me know what you think. Okay, where I come from is, look, if you've got a residential mortgage, when rates are at 1.5–2%, okay, that's a roof over your head and over your family's head. Okay, pay down that mortgage if you can. Okay, because right now rates are low. We're not going to get into this position in the next couple of years. I believe rates are going to go higher. Okay, and I think they will keep going higher. Okay, now interest rates is something interesting because I believe interest rates, they were primed to go up just before Brexit. Okay, however, Brexit didn't go the way that they wanted it to go, or they thought they would go, and because they had to stabilize the pound and they had to stabilize the market, they had to keep interest rates low. Okay, and obviously the interest rates remained low before the last crash in 2007, 2008. Interest rates were like 4%, 5%. Okay, so that was the norm. Okay, so they only went down because of that crash. Okay, then we had Brexit, they remained low. Okay, then they were going to look to creep it up, and then COVID hit. Okay, so then again, you got to keep it low, right? But we're in this situation now that inflation is running away with things, and they're going to have to raise rates to keep that level. They've been wanting to raise the rates for many, many years. Just the environment wasn't ready. And I'm not saying interest rates we're in prime environment for them to go up, but I think the government has got no choice because it's a global inflation issue. Okay, this is not a UK or Little England problem. Okay, and I don't think governments are necessarily to blame on what happens. They don't really. The Bank of England really calls the shots on this, and they are. In my opinion, again, I think they're going to push the interest rates higher and higher if they can. Now, I don't think it's going to get silly. I don't think it's going to be 6%, 7%, but I think they will need to push those interest rates up. So what I mean by that now, right? So interest rates are going to go up, okay? We know it's going to go up. So why don't you start paying your mortgages? Why don't you start paying those lump sums, making those 10% overpayment facilities, bring the level of debt manageable. Now, this is what I mean. If you're on 150K a year and your mortgage is $2,000 a month, that's manageable for you, okay? But if you're not, and you've taken all of this out, you've refinanced to buy other buy-to-let properties, and you're going to buy loads of other properties, you're going to be heavily geared when things go wrong. Now, the last time interest rates really got affected was in the 80s, late 80s, 90s. Not the last crash. The last crash, I was in the mortgage industry. I worked for one of the largest mortgage entities out there in the country, okay? In 2007, we did 7 billion worth of mortgages, okay? And I was the marketing director for a very large organization, 450 staff, bang in the middle of Tottenham Court Road, and I've been in the market, and then when that company went under because of the crash, okay, myself and Richard, we became mortgage brokers. So I was dealing with the problems of that crash and people heavily gearing themselves up for many years afterwards as we were mortgage brokers. I was literally talking to lords that had 20 properties that were getting repossessed, or they were having problems, or they have CCJs. There were people going through IVAs, people going for bankruptcies, people basically, their lender was writing to them, especially on the commercial side, saying, you don't have enough equity, you need to give us another 150, 200 on top. There was all sorts of things happening, and I was the guy speaking to those people. Okay, look at these grey hairs. Okay, these grey hairs, right? Where, you know, when back in the day, right, I was speaking to those people. I was having those conversations where portfolios were overly geared, lenders were going bust, they wanted money back, there were issues around valuations, there were down valuations happening. All of those things were happening, right? And generally that happened to people that were not cautious and they were gearing themselves too much. They thought the world was just so simple. It was so easy. And guess what? Everybody thought at that, I mean, I was there at that age. Everybody thought everything's going to be great and everything's going to continue. What I'm saying to you guys is invest in property. I make my money out of people investing in properties. I'm a mortgage broker. I deal with buy-to-lets. I've got buy-to-lets. I've got interest-only mortgages, okay? I'm not talking about don't do it. I'm saying be cautious with what you can, right? Fix the roof while it's sunny. Make sure your residential property is covered. Make sure you're paying down your debt on your residential property, because if something happens, you get hit by a bus tomorrow, okay, you know you're secure, or your family's secure on your residential side. Okay, investment properties are different. Okay, in my opinion, they're different. Okay, because you don't, you know, it's someone else's house there, right? I'm not saying kick the tenants out, but what I'm saying is you need to look after your interest first. Make sure you can. Okay, we're in this situation now. Back in the late 80s, 90s, early 90s, property prices in West London, where I lived, were about 100k. You could buy a semi-detached house for about 100k, right? 150k, 100k, right? Mortgages were like 60k, right? Yes, interest rates went up to, I don't know, 15% on 60k, right? Those same properties are worth 600 now, and they've probably got gearings of 350, 400k. So it only needs to go to 6% where people will genuinely find it difficult, right? Now, put that together with the laws that we've got at the moment, okay? You've got the tax changes that have happened, which has hammered landlords, right? You've also got the laws around someone can literally not pay you rent and stay in that house for a year. You've got to take them to court. You've got to go through the cost of taking them to court. Okay, so there are fundamental problems within the system that the system's broken. Okay, you know, literally someone can get into your house and you would have to go through the legals to get them out. Okay, just imagine that happens to one of your properties, two of your properties, and then you've got some rental voids. Okay, so what I'm saying is be cautious, be conservative with what you're doing. I'm not saying don't invest in properties. I'm not saying, you know, just be an old guy and just pay your mortgage and don't do anything. I'm saying do everything if you can. If you want to invest in stocks and shares, obviously do your own research. Do so if you want. If you want to invest in properties, do so. But just make sure, number one, your residential mortgage is covered and you're doing something to pay that off while you can. Okay, depends on your circumstances, depends on what your earnings are, depends on your family structure, depends on whether you've got people to fall back on, assets to fall back on, properties to fall back on, savings to fall back on. But you know, a lot of those people that are advocating gearing yourself up, one, they've either got interest in selling you something, whether it's a course, whether it's properties, whether they're estate agents, whether they're I don't know, managing agents, whether they're deal sources, things like that. And my game, I've got an interest. My interest is I want you to use me as a mortgage broker. But what I don't want you to do is 2 years down the line come to me and say, do you know what, Payam, you need to help me out because I'm going to get repossessed. Okay, and like I said, I've got that level of experience because I've been in the industry, I've been a landlord and I've been a broker, and I speak to hundreds of people, hundreds in a monthly basis that are trying to do something with property. So take that on board, hopefully, but let me know. If you think I'm talking nonsense, let me know. If you've got a different strategy, let me know. If you agree with me, let me know. Please do, and I'll catch you on the next one. Take care. The content of this video does not constitute giving advice. It's purely for information purposes. All cases should be discussed with a professional mortgage broker. As a mortgage is secured against your home or property, it could be repossessed if you do not keep up mortgage payments. Niche advice is authorised and regulated by the Financial Conduct Authority.